So how is the industry being disrupted specifically, and what do we do about it? There has been, the word disruption now is sort of commonplace. Everyone understands it. We talk about it all the time. And it's the existential threat of the insurance industry, but really any entrenched industry has to worry about the external disruption. And I mean, there's a lot of great examples of it. Examples that I think even, are similar to what we're going to have to deal with in the insurance industry. I think Uber and Lyft are good examples because there's some lessons to be learned. And one of the lessons is that, while not highly regulated like the insurance industry, most cities had actually we're in New York City. New York City was one of the hardest areas for Uber to get into, because there was such regulation around who could do taxi services in this city. And Uber spent a lot of time sort of lobbying the city and trying to get permission to do it, and really how to work the system. But at the same time, they're also getting very successful. There are other cities where they've kind of gone in sort of under the radar, just started working, and then the city says, hey, you're not following the same process that all our other cab services are following. And they said, we're going to kick you out. But by that point, it was too late. People loved them so much that they would then fight City Hall and start electing different people into the city government who were going to be sort of welcoming to Uber. And that is the kind of thing, insurance is obviously way more regulated than any of these other industries. But at the same time, if somebody comes in and starts selling insurance in a different model and is sort of flaunting the regulations, there'll be crackdowns on what they're doing, but there's also going to be this kind of meet in the middle approach. In some ways, that'll be good for us. There'll be third-party startups or third-party big firms, like Google, who get involved, who actually push to change some of the regulations. And that'll actually, once those regulations change, all insurers will essentially have the ability to be a little more flexible as well, as long as we're ready to take advantage of it. If someone comes in and shakes things up, and the business model sort of changes to adapt to that, and you are not ready to adapt to that changing business model, you're going to lose a lot of business. You're going to end up, you don't want to just become a book of business that someone else acquires. But that will happen to some companies as this disruption goes on. Personal auto, I talked about earlier, that was a disruption that came from within the industry. Just, Progressive essentially used data analytics to identify the fact that there was this level of customer who was being poorly served. They were kind of the best of the bad drivers, the people who were being rejected by the AAA insurers, so therefore being pushed down to sort of the third tier of auto insurers and being charged a lot. And Progressive realized, no, a lot of these people are actually decent drivers. We can price things just right so that we take that cream of the crop. And that turned out to be huge, and they did that for many years, and they just got in a lot of business, and they used that business to create a war chest for advertising, and then they spent hundreds of millions, billions of dollars on advertising, and now they've got everybody, and now they run around the marketplace. Tesla is another great story. Actually, I'll do Vonage next because we're in New York City again. When I moved to New York, it was $70 to get local phone service with Verizon. Okay, $70 a month, all right, for just local calling. And it's because Verizon owned New York City phones. And then Vonage came in, voice over IP. It was really the first entrant to the marketplace. And it was like $12 a month for voice over IP calling. And everyone switched to it because it was $70 on Verizon. And lo and behold, Verizon lowered their price for local phone service to like $15, the next year. And this idea of getting around this entrenched infrastructure with the alternatives has been, radicalized the industry. And then Tesla, for all the auto insurers, has been, we talk a lot about self-driving cars, but one of the things that Tesla is actually up here because they sell direct rather than through the auto dealers. That's a big deal. But my favorite Tesla story is about this time when a woman was stopped at a light and someone hit her from behind and claimed when the cop came that she had hit reverse when the light turned green and hit him. Well, I guess Tesla heard this, and she was driving a Tesla. Tesla heard this dispute was going on, and they just went into the car's computer and said, actually, between the hours of 3:30 and 4:30, at no time was this car in reverse. The person behind her is lying. He must have hit her, and case closed. And that's going to be in every single car. As soon as cars have some self-driving capabilities, and the risk and essentially the manufacturers are going to be liable for problems, every car will essentially track the driving history, the patterns, what happened in accidents. It's going to completely change how auto insurance works. It's all around us. I've talked about a lot of these different examples. I'm not going to go through more external examples, but the point is that this is happening all the time. It's not a new thing for disruption. That's the picture of the Ford. We're talking about the manufacturing process for cars, right, is an industry disruption. It's always going on. Now, this is not a new threat. It's already happening in insurance. It's direct to consumer sales has been a threat for a long time. It's been something the industry often is pushing back against. But we're seeing a lot of it's moving outside of personal lines. It's happening in commercial lines. It'll happen in, there may be areas that are mostly protected from this, but even when you talk about large commercial or big group insurance, and you still think, oh, well, we're always going to need somebody out there selling it, there'll be more and more components of it that go direct, more ways of making it more efficient that are still going to change the way it's done. The auto insurance is already being impacted by, some of these examples are all happening in auto insurance right now. Self-driving cars are going to completely change the model of the industry. If you're an auto insurance company, whether commercial or personal auto, you need to be prepared for the fact that self-driving cars are going to change risk. Now, in some ways, I think about this like cloud computing. It's a sort of a far-off metaphor, but when cloud computing started becoming a big thing, and everyone was afraid that all of the people who produce servers were going to go out of business because people wouldn't be buying servers for themselves anymore. What ended up happening was, while that is true, there's less investment by smaller companies in servers. The data centers that provided cloud computing services exploded, and actually server sales have gone up. But instead of it being sold to individuals, it's being sold to these big data centers that do cloud computing. Amazon, Microsoft Azure are buying more and more servers, huge number of servers. And so it's actually been good overall for the server industry. Something similar will happen with auto insurance. Just because we go to self-driving cars doesn't mean cars won't need to be insured, but the nature of that insurance is going to change. Instead of individuals buying insurance, there'll be much more of that insurance will be happening from the manufacturer end. I've built a self-driving car. I'm Google, I'm Ford, I'm Tesla. I need to be insured because if that self-driving car gets in an accident, it's not the person, it's no longer the driver's fault, it's my fault. But that does mean a fundamental shift. You're not necessarily going to have as many small personal lines auto insurers. You're going to have much bigger insurers who are sort of having a big piece of the pie. There's also really disruptive things happening. I talked about Tesla's sort of the computer, but it goes beyond that. We'll see self-reporting. They'll be able to understand the damage they've suffered. The whole car will be wired to essentially calculate costs right on the spot. That whole process will be able to be automated. Claims adjusters will become less relevant in that picture. We're seeing a lot of drones changing the industry. While I'm not a gadget person myself, I don't own a drone. I really love thinking about where areas that they'll be able to change. Instead of sending somebody a claims adjuster up to a roof, an insurer can send a drone up. So that's an insurer changing the way they do their job. They'll have to train people to fly drones rather than climb ladders. But we'll also have to insure other companies doing something similar. If a company is using drones for high-risk tasks rather than people, well, then we can, they should get a discount because they are going to be putting people in less dangerous circumstances. At the same time, what if that drone crashes into somebody else's building? There's a whole new area we have to insure. So there are new risks and some risks go away, some new risks come up. I've also mentioned Google Compare. We were talking about that earlier. We are seeing big tech companies, big external companies start putting their sights onto insurance. Anywhere you see an industry that makes money through knowledge, ownership, and sort of channel aggregation, there will be external players trying to take a piece of that. And that's where I see Google coming on board, not trying to be an insurance company, but taking advantage of the fact that they have all the knowledge. They have so much more information than anyone. They can do a better job of aggregating different insurer information, presenting it to the consumer, taking a piece of that pie. That's a real threat to the agent channel. It's a real threat to insurers who have pushed back against comparative raters. And it's, there's always been a fear in the industry that comparative rating and sort of the online channel would turn insurers into a commodity that's just competing on price. And that is certainly happening in personal lines insurance. And it will always be a balance, because in the end, people buy things not just based on price, but based on experience, based on ease of doing business with someone, but based on marketing and branding. And so it is changed now, and it is continuing to change. And that will happen more than just personal lines. Just personal lines tends to be where things start first because of the high volume turnover. But it's happening in commercial lines, it's happening life, it'll eventually happen in group voluntary benefits as well.